Imagine waking up one day to find the value of your home cut in half, your mortgage payment skyrocketing, and buyers nowhere to be found. Experts warn this nightmare could become reality by 2026, with millions of families at risk of losing everything. The U.S. housing market is far more fragile than most realize, and the cracks are already showing. From soaring debt and corporate greed to climate risks and policy failures, powerful forces are converging. The question is no longer if the collapse will come, but when. And the signs suggest the countdown has already begun. Number 10. The psychology of panic selling. One of the most unpredictable and dangerous forces threatening the housing market is the psychology of panic selling. Unlike interest rates or construction numbers, panic isn't rooted in math, it's rooted in fear. When homeowners believe prices will continue to fall, a wave of anxiety spreads. Families rush to sell before values drop further, creating a sudden surge of listings. At the same time, buyers, sensing weakness, hold back and wait for even lower prices. This imbalance, more supply and less demand, accelerates the downturn. What begins as a cautious decision quickly snowballs into a full-blown crisis. Every new, for sale, or foreclosure sign becomes a visible reminder that values are collapsing. Neighborhoods change character as homes sit vacant, businesses lose customers, and local confidence fades. Even families financially capable of holding on may decide to sell, fearing deeper losses in the future. The most dangerous aspect of panic selling is how fast it spreads. Unlike government policy or bank regulations, fear moves at the speed of conversation, headlines, and social media. Once confidence is shaken, no amount of reassurance can stop the slide immediately. And as history shows, housing markets are not driven by numbers alone, they are driven by stories people tell themselves about the future. Number 9. Natural disasters and climate risks. One of the most underestimated threats to the housing market is the growing impact of natural disasters and climate change. Homes are not just financial assets, they are physical structures tied to land, weather, and geography. As floods, wildfires, hurricanes, and heat waves strike more frequently, families living in vulnerable regions face rising insurance premiums, mounting repair costs, or even complete denial of coverage. A property that once symbolized security can suddenly transform into a financial trap, draining savings instead of building wealth. When insurance becomes unaffordable or disappears altogether, property values collapse, leaving homeowners stuck with homes they can neither sell nor protect. The ripple effects extend far beyond individual families. Entire communities can hollow out as residents flee disaster-prone areas in search of safety, depressing local values while driving up costs in safer regions. Banks and lenders grow cautious too, tightening credit in risky zones, which makes mortgages harder to secure. Over time, cities repeatedly hit by disasters see their tax revenues decline, infrastructure weaken, and job opportunities shrink. This cycle of decline creates instability that spreads outward, turning local housing struggles into regional or even national crises. A once thriving neighborhood can become a ghost town simply because the environment can no longer sustain long-term living. By 2026, if climate risks continue escalating, vast portions of the U.S. housing market could become economically unlivable. The losses won't just be financial, they'll be social and humanitarian as well. Families uprooted by fires, floods, or storms are forced to start over, while investors lose faith in markets tied to high-risk geographies. Experts emphasize that housing stability cannot exist without environmental stability. Ignoring these risks is not just short-sighted, it is dangerous. Natural disasters may very well be the tipping point that turns today's fragile housing system into tomorrow's collapse. Number 8. Policy failures. Government policy has always played a central role in shaping the housing market, but when those policies fail, the consequences can be devastating. From zoning laws and tax codes to lending regulations, small decisions ripple into the lives of millions of families. In many cases, housing policies have been too rigid or too lenient, either blocking new construction where it's needed most or allowing reckless lending practices that inflate dangerous bubbles. The result is the same, a fragile system that cannot adapt when pressure builds. Promises of affordable housing often fall short, while tax breaks and incentives frequently favor investors and large corporations over ordinary families. These policy failures make the market more unstable over time. Renters are left exposed by weak tenant protections, while first-time buyers are priced out by competition from institutional investors. In past housing crises, the lack of oversight on risky mortgages, like adjustable-rate loans, was a key trigger. Without stronger enforcement, history could repeat itself, leaving families burdened with loans they cannot sustain. At the same time, climate policy failures add another layer of vulnerability, as new homes continue to be built in flood zones and wildfire-prone areas without sufficient safeguards. By ignoring long-term risks, governments unintentionally set the stage for collapse. By 2026, the cracks created by these repeated missteps could widen into a full-scale disaster. Without bold reforms, such as stronger protections for renters, smarter lending regulations, and serious investments in affordable housing, the system remains a ticking time bomb. Experts warn that policy failures don't just make the housing market inefficient, they make it dangerous. When millions of families live one paycheck away from foreclosure or eviction, even a small shock can ignite a nationwide crisis. In short, weak or outdated policies are not just mistakes, they are active drivers of the looming collapse. Number 7. Corporate landlords and speculators. Over the past decade, one of the biggest shifts in the U.S. housing market has been the rise of corporate landlords and large-scale investors. Hedge funds and private equity firms have bought tens of thousands of homes, often paying in cash and outbidding ordinary families. Instead of being purchased by first-time buyers, these homes are turned into rental properties managed for profit. This trend pushes homeownership further out of reach for many, while simultaneously driving up rents. Housing, once seen primarily as shelter and stability, is increasingly treated as just another financial asset, making the entire market more volatile. The danger becomes even greater during times of stress. Many corporate owners operate with a short-term mindset, seeking to buy low, rent high, and sell quickly once values peak. If market conditions shift, such as falling home prices or rising borrowing costs, these investors can pull out just as quickly. A mass sell-off by large firms would flood the market with properties, dragging down values across entire neighborhoods. Families who bought during the peak would suddenly find themselves underwater, while renters could face rising rents or sudden eviction as corporate owners chase profits over stability. By 2026, the concentration of ownership in the hands of a few powerful players could amplify risks for everyone. If these companies face financial trouble, the impact would ripple far beyond individual households, affecting entire communities. Experts warn that when too much control rests with profit-driven institutions, housing loses its human element. It stops being about families and neighborhoods, and instead becomes a speculative game. This shift doesn't just make the market fragile, it makes it less humane. Corporate landlords and speculators may appear to strengthen the system, but in reality, they could be accelerators of the next major collapse. Number 6. Global economic slowdown. The housing market does not exist in isolation, it is deeply tied to the overall health of the global economy. When growth slows worldwide, the effects trickle down into every household. Sluggish trade, rising energy costs, and disruptions in global supply chains reduce business confidence and slow hiring. Families facing uncertain job prospects or lower incomes delay big financial commitments, especially home purchases. With fewer buyers in the market, demand softens, prices weaken, and sellers are left scrambling. Housing thrives on optimism and stability, and when the global economy falters, confidence disappears almost overnight. International crises magnify these risks. Wars, political instability, and oil shocks can push inflation higher, forcing central banks to raise interest rates. While intended to stabilize prices, these hikes also make mortgages far more expensive, discouraging buyers and straining current homeowners. At the same time, foreign investment in U.S. real estate can shrink during global downturns, reducing liquidity and leaving sellers with fewer options. Developers also suffer as financing dries up, halting new projects, costing jobs, and weakening local economies. Every layer of the housing system, from buyers to builders, feels the pressure when the global economy slows. By 2026, if the worldwide slowdown deepens, the housing market could be one of the first sectors to show cracks and one of the last to recover. High debt levels, weak wage growth, and declining consumer confidence would combine to create a fragile environment where even small shocks trigger outsized effects. Experts caution that housing collapses often begin with global economic weakness that spreads locally, eroding confidence and wealth. If international instability continues, the U.S. housing market could face not just a downturn but a prolonged collapse, one fueled as much by global forces as by domestic missteps. Number 5. Overbuilding in risky areas. When housing demand is strong, developers often rush to build as many homes as possible, sometimes without considering whether those areas can truly sustain long-term communities. The result is overbuilding. Entire neighborhoods constructed in regions with weak job markets, poor infrastructure, or shrinking populations. At first, buyers may flock to these developments out of fear of missing out, but once demand cools, many of these properties sit vacant. Streets of half-empty houses create ghost neighborhoods, dragging down nearby property values and eroding confidence in the broader market. What once looked like growth turns into a glaring symbol of oversupply. The problem becomes far worse when overbuilding occurs in environmentally risky locations. Homes built in floodplains, wildfire zones, or hurricane-prone regions may sell initially, but they quickly become liabilities as disasters grow more frequent and severe. Insurance premiums soar, maintenance costs spike, and in many cases, coverage becomes impossible to secure. Families suddenly find themselves owning homes that are not only expensive to maintain but also unsellable. When these properties inevitably lose value, the ripple effects extend beyond the high-risk zones, destabilizing nearby markets as well. Short-term profit-driven construction decisions can create long-term systemic risks. By 2026, the consequences of overbuilding in the wrong places could weigh heavily on the housing market. Developers focused on chasing quick profits leave behind fragile communities that lack resilience when times get tough. Families trapped in these areas face declining services, shrinking schools, and deteriorating infrastructure, which only accelerates the downward spiral. Experts warn that large numbers of newly built but undesirable homes could become stranded assets, properties no one wants to buy or insure. This doesn't just waste resources, it weakens the stability of the entire market, turning local oversupply into national vulnerability. Number 4. Decline in housing affordability. For generations, owning a home has been the cornerstone of the American dream, but that dream is slipping further out of reach. Incomes have not kept pace with the rapid rise in housing costs, leaving millions of families unable to afford even modest homes. First-time buyers, once the lifeblood of the housing system, are now sidelined as prices soar beyond their budgets. Many are forced into renting, but with rents climbing at record rates, saving for a down payment becomes nearly impossible. This affordability crisis is not just an inconvenience, it's a structural weakness that undermines the entire market. The effects ripple far beyond individual families. Without a steady stream of first-time buyers, the market becomes stagnant. Sellers struggle to find qualified purchasers, leading to homes sitting on the market longer and, eventually, price cuts. Those who bought at inflated prices risk sliding into negative equity, where their mortgage debt exceeds the home's value. This creates a dangerous psychological shift. Instead of seeing their home as a stable investment, families feel trapped in a financial burden, increasing the likelihood of walkaways and foreclosures. As more properties hit the market under distress, prices fall further, feeding the cycle of decline. By 2026, if affordability continues to erode, the market could reach a breaking point. Younger generations may delay major life milestones like marriage and family because stable housing feels unattainable. Businesses in urban areas struggle to attract workers when employees can't afford to live nearby, weakening local economies. Communities hollow out as families are pushed farther from city centers, enduring long commutes and reduced quality of life. Experts warn that a market built on excluding the majority of households is unsustainable. Unless affordability improves, housing could collapse under its own weight, taking the dream of ownership down with it. Number 3. High household debt. The strength of the housing market depends not just on home prices but also on the financial health of the families living in those homes. Today, U.S. households are carrying record levels of debt, not only from mortgages but also from credit cards, auto loans, and student loans. For many families, every paycheck is already stretched thin, leaving little room to handle higher housing costs. When debt consumes such a large share of income, even small economic shocks, like a rise in interest rates, job loss, or a medical emergency, can push families into default. A housing market built on fragile household finances is always one step away from collapse. The danger is compounded when interest rates rise, making it more expensive to carry existing debt. Adjustable-rate mortgages reset higher, credit card balances grow faster, and refinancing options disappear. As monthly obligations increase, families are forced to make difficult choices: delay paying bills, cut back on essentials, or fall behind on their mortgage. Once foreclosures begin, the ripple effect spreads quickly. Home values drop, lenders grow cautious, and confidence in the market erodes. Debt, which once fueled consumer spending and housing demand, suddenly becomes the very weight that drags the system down. By 2026, the burden of household debt could be one of the most direct triggers of a housing collapse. Families already stretched beyond their limits will have little ability to absorb further shocks. Experts warn that debt-driven collapses don't just destroy wealth, they destabilize entire communities. Neighborhoods marked by foreclosures see rising crime, falling tax revenues, and declining schools, creating a downward spiral. Unless debt levels are brought under control, the financial pressure on households could transform isolated defaults into a nationwide crisis, pulling the housing market, and the broader economy, down with it. Number 2. Banking system fragility. Behind every home purchase lies the banking system, providing the mortgages that make ownership possible. But banks themselves are not invincible, and when they show signs of weakness, the entire housing market becomes unstable. Many financial institutions still carry exposure to risky loans, commercial real estate, and volatile assets. If defaults begin to rise, banks may tighten lending standards, making it harder for families to qualify for mortgages. Even buyers with steady incomes and good credit could be shut out of the market. Without accessible credit, demand dries up, and home prices start to slide. The problem deepens when banking instability spreads fear throughout the economy. Just as in 2008, even the perception of fragility can trigger panic. If people believe banks are unsafe, they pull deposits, lenders retreat, and investors sell off housing-related assets. Small and regional banks, often critical to local housing markets, are especially vulnerable, since they lack the capital reserves of larger institutions. When these banks falter, construction loans disappear, mortgage approvals plummet, and entire communities lose access to financing. Housing markets don't collapse in isolation, they collapse because the financial system that sustains them breaks down. By 2026, experts warn that stress in the banking sector could easily spill into housing. A wave of foreclosures or widespread loan defaults would put enormous strain on financial institutions, which in turn would amplify the crisis by restricting credit even further. The cycle is self-reinforcing. Weak banks lead to weaker housing, and weaker housing leads to even weaker banks. Without strong oversight and reform, the financial system remains a hidden fault line beneath the market. One major shock could turn fragility into failure, pulling millions of homeowners and buyers into the fallout of another devastating collapse. Number 1. Interest rate shocks. Few forces influence the housing market as directly, or as brutally, as interest rates. Mortgages are long-term commitments, and even small changes in borrowing costs can mean hundreds of dollars more each month for homeowners. Over the past few years, interest rates have climbed at one of the fastest paces in history, pushing affordability to the brink. For families already struggling with high home prices, these rate hikes lock them out of ownership entirely. Demand falls, sellers cut prices, and the entire system begins to cool. What starts as an adjustment in monetary policy can quickly snowball into a nationwide housing slowdown. The danger intensifies for those who already own homes with adjustable-rate mortgages. As rates reset higher, monthly payments surge, forcing households to either absorb the cost, refinance at unfavorable terms, or risk default. During past crises, this dynamic fueled waves of foreclosures as families simply couldn't keep up. Investors, too, retreat when rates rise, since higher borrowing costs erode profitability. Construction slows, sales drop, and confidence in the housing market begins to unravel. Rate shocks don't just affect affordability, they paralyze the entire ecosystem of housing. By 2026, experts warn that interest rate volatility could be the single most important trigger for a collapse. If rates spike again, or even remain elevated while wages stagnate, millions of families could find themselves priced out or pushed into foreclosure. At the same time, falling rates after a spike could destabilize the market in the opposite direction, reigniting speculation and fueling bubbles. The unpredictability of interest rates leaves homeowners, buyers, and investors walking a financial tightrope. Ultimately, interest rate shocks are not just numbers on a chart, they are the knife's edge that could determine whether the housing market stabilizes or plunges into its next devastating crash. The U.S. housing market stands on the edge of a storm. From interest rate shocks to policy failures, from rising debt to climate disasters, each warning sign points to a system stretched to its breaking point. History shows that collapses rarely come from one cause, they come when multiple pressures hit at once. By 2026, millions of families could be caught in the fallout if these risks are ignored. But awareness is the first step toward protection. Whether you're a homeowner, renter, or investor, understanding these dangers is critical. The choices made today will decide whether housing remains a foundation of security, or becomes the trigger for America's next great financial crisis.